I'm Howie Lim. This is Money Hacks by the Business Times. Global bank stocks have recently declined, reflecting trade tensions in global markets. In Singapore, DBS, OCBC and UOB saw an average decrease of 1.4%. At the same time, recent US inflation data fell short of expectations, raising concerns about a weakening economic outlook in the US. Okay, before you grumble, tell me something I don't know. Given the potential for Reits to outperform in a muted Singaporean economy due to their attractive dividend yields, the question arises, should investors consider shifting their investments from banks to Reits? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. And helping us out today, Daphne Tan, Head of Business Development at CMC Markets Singapore, and Ritesh Ganeriwal, Managing Director and Head of Investment and Advisory at Syfe.
Thank you for having me, Howie. For STI, it has been about a 2 to 4% performance year to date because we did see a dip recently and it's been recovering. For REITs, we can see about an average of 5 to 10%, in which case for the Singapore banks, you would see about a 6 to 12%. So what we can see from this is a little bit of a rotation is happening. And because REITs also tend to preempt a lower rate type of environment, so we can see that transition happening now.
Last few years, the banks, they usually excel in a rising interest rate environment and when there is an economic expansion of sorts. So they benefit from a wider net interest margin and increase in volumes of loans, etc. as well. And this has been the case so far, which again has driven record profits for the banking sector. In contrast, if you think about S-REITs, they usually face headwinds in a rising interest rate environment and their cost of borrowing increases, they reduce their distribution income, while, some of their fixed costs remain as is. So higher rates usually make REITs, the yields less attractive relative to, newly issued bonds, etc., often pressurizing the REIT valuations. However, if the trend forward is more that the rates are going to come down, then in a stable or falling interest rate environment, we are clearly at peak rates. Rates are at peak. There is rate cuts that are on the horizon. And if that is going to happen, we expect the REIT sector to perform well with lower rates as it reduces their borrowing costs and make REITs yields much more attractive.
That was Ritesh Ganeriwal from Syfe, and Daphne Tan from CMC Markets agrees that S-REITs definitely benefit from a lower interest rate environment and rate cuts as that lowers financing costs,
which then improves the REIT profitability. Also, sometimes what we see is investors hunting for yield in a softening inflation environment, in which case for S-REITs, because they offer about a 5 to 7% dividend yield, that tends to be what's favored in this type of environment. And there's also a return of stability in property demand, particularly in the commercial sector. So for logistics or commercial offices, there is increased investor demand for defensive income-generating assets.
Sure sounds like a resounding yes at this point. Good times for banks over? Surely not.
So for banks, we are in a little bit of an in-between because they do perform in a high interest rate environment or even a slow cut environment, which is what we are seeing now since there has been a pause. So it's generally still good for their net interest income. But if we do transition to a lower interest rate environment, then investors might need to do a little bit of reallocation in their portfolios. So for Singapore banks in particular, they also benefit from very resilient regional exposure, and they do provide stability and dividend yields between about 4 to 6%. So for STI, it benefits from market stability or steady macro outlook. So what we can see in this current environment is that while Singapore itself, while the macro environment is uncertain, we are not as affected. And we do have a very resilient banking sector, which does have a heavier weightage in the STI itself. So these conditions do benefit the STI, and investors do tend to want diversified exposure, hence increasing the demand for STI as well.
So banks usually thrive when there is an economic expansion and there is moderate inflation. helps with their net interest margins. But current indicators suggest that there is a shift from an inflationary rising rate regime to a more disinflationary and an easing regime, which is more REIT friendly. If you think about valuations and yield spreads, etc., as well, REITs trade at around 100 basis points of an advantage compared to the banks. The regulatory environment is also much more favorable for REITs. From a fundamental standpoint, the Singapore REIT market does show a lot of resilience with high occupancy rates in prime assets. And again, if the economy avoids hard landing, REIT distributions could grow in 2025. So overall, if we can avoid a recession, I think REITs are poised to benefit with a lower interest rate environment. If we can't avoid it, then I think on a relative basis, still REITs are better poised to handle the situation compared to the banking world.
Okay, stop yelling, what about diversification at me? I'm sure the experts will have something to say about that, and I don't think it's one or the other. More with Daphne Tan, Head of Business Development at CMC Markets Singapore, and Ritesh Ganeriwal, Managing Director and Head of Investment and Advisory at Syfe, in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. We've talked about how S-REITs have been doing better than the STI and banks even so far. What about their outlook going forward? What risks may they face and how much should we put into them? Here's Ritesh from Syfe.
We don't want to put your eggs in one basket. We obviously always want to encourage a diversified portfolio. Put into context the kind of economic cycle that we are in. There is a high concentration of banks in the STI index, more than 55%. So if you want to diversify, having that REIT allocation, and especially if you are someone who is looking to generate yield and dividends, there is a story of resurgence coming in on the REIT sector. If you are even more conservative, I believe you can still look at bond yields, still pretty decent, high quality investment grade with mid duration, etc. So if a combination of banks, REITs, and high quality bonds, that's your ideal strategy to keep a very stable and consistent dividend yield profile without being subjected to too much of this volatility that we are observing in the market. If you really want to be active in the market and you want to capture this reversing trend of sorts, then there is a story of potentially overweighting or shifting from higher bank allocations to evening out and adding that REIT allocation. Or if you already have REIT exposures, probably a time for you to add to it as well.
So I would say there are about 5 aspects. We have already talked about interest rate expectations as well as the economic cycle positioning, which is in anticipation of a soft landing where global growth remains moderate and inflation softens. So the regulatory policy environment. So for S-REITs, MAS and SGX, they do support REIT market development. And also locally, we do have CPF investment schemes, which show ongoing support for CPF-linked REIT investments. And the thing about REITs is that it's policy neutral. So unlike property investments such as HDBs, for example, which are subject to cooling measures, REITs are not subject to such things. So that does play a part. And you also have the real estate sector fundamentals. So for logistics and data center REITs, when we talk about REITs, we also have to talk about how they are classified. So for logistic and data center, they do benefit from structural demand and where the world is moving in this case. And we are also seeing some office recovery. Retail REITs are rebounding selectively because they also do tend to be more sensitive to economic impact. So we can include those 2 factors as well.
There you go. Diversify, diversify, diversify. Feels like there isn't much left to say, really. That's always been the advice, hasn't it? But how about some tips for a strategic portfolio approach from our experts?
It all depends on, what you're trying to solve for. If you are a growth investor, obviously you would look at equities to drive that growth factor for the long term. And when you think about strategic asset allocation, you should not be reacting to short-term market impacts, etc. and all. When you're looking at dividend income, this is where I believe, first of all, you need a very stable base. And usually that stable base is provided by, your bond world. So you should have fixed income as the core building block when it comes to income generation. And then when it comes to enhancing your yield, Singapore Reits is a strategic allocation that can come in to enhance that yield. Alongside banks, alongside, other high dividend paying and consistently dividend paying stocks as well. But within a Singaporean context and Singapore dollar income that you're trying to generate, there are only those many options available. So banks and REITs become the fundamental components in that kind of context as well.
So let's say someone's portfolio consisted of Singapore banks, S-REITs, and the STI. If they were to take a income-focused defensive approach, in which case what their portfolio they might want to consider looking like now to benefit from the pivot, because S-REITs do tend to be a little bit of a forward signaling type of asset. Let's say they have 50% in S-REITs, 40% in banks, and then 10% in the STI, because we have mentioned that STI would probably be most impacted by the recent tariff news. So with this type of allocation, what investors tend to get is maximizing stable income from the dividend yield, and they're also focusing on capital preservation because these are fairly low volatility assets. So that's one approach. We have a second approach, which would be more balanced. So while you do get yield, you also get growth that would consist of, let's say, 35% in Singapore banks, 40% in REITs, and about 25% in the STI, because the tariff situation tends to be quite fluid, in which case, if they want to be a little bit more risk on, they can consider this type of allocation to gain more upside potential from STI-linked sectors. So the last one would be a growth-orientated tactical type of approach, where you have about 25% in Singapore banks, 50% in S-REITs, and 25% in the STI. So while investors would be positioned for the REIT rebound, they also get a higher percentage from stable assets such as banks, blue chip, dividend yielding, and an equal percentage in the STI for growth, for example.
Takeaway order Money Hacks 220 is ready. By all means, pivot towards an asset class which looks to do better soon, but always stay diversified. That way, you'll always have an asset class which will do better soon. A big thank you to Daphne Tan, Head of Business Development at CMC Markets Singapore, and Ritesh Ganeriwal, Managing Director and Head of Investment and Advisory at Syfe. I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.